Hey, welcome back. Today we are diving into one of the most bizarre economic paradoxes in the modern world. Japan, a country sitting on nearly $4 trillion in overseas wealth, where the average worker's paycheck keeps shrinking. This is episode 3 of the Japan Economy series. Let us get into it. Here is what we are covering today. 7 sections. About 17 to 19 minutes of content packed into 25 slides. We will go from the basics of what a creditor nation actually is, to why wages never went up, to the wild twist happening right now in 2026. Stay with me, this one is worth it. Before we dig in, here are the numbers that define this whole story. 562 trillion yen in net foreign assets, all-time high. Creditor nation rank, number 3 in the world. 2025 real wages, down 0.2%, the 4th straight annual decline. Labour share of GDP, around 46%, well below the OECD average. And then the twist. February 2026, real wages up 1.9%, first rebound in over a year. Look at this chart. Japan net foreign assets have been on a nearly unbroken climb since 2000, going from about 133 trillion yen all the way to 562 trillion in 2025. That is a 4 times increase in 25 years. On paper, Japan has never been richer as a nation, so the question is not whether the money exists. It absolutely does. The question is, who actually has it? And where is it going? Here is something that does not get enough attention. Japan was the world #1 creditor nation for 33 consecutive years. Then, in 2024, Germany knocked them off the top. And by 2025, China pushed them down to number 3. Their assets are at an all-time high in yen terms, but in dollar terms, the weak yen has been quietly shrinking the value of those holdings. You can be getting richer in yen and poorer in dollars at the same time. That is the trap. Okay, let us set the scene. Imagine someone who has got millions stashed in overseas. Investments, real estate, bonds, stocks, all over the world. But every single month, their paycheck is shrinking. How does that even happen? That is literally Japan right now. $3.8 trillion in net foreign assets, number 3 on the planet. And yet, for every single month of 2025, Japanese workers saw their real wages go down. So, where is all that money? First, let us break down what creditor nation actually means. It just means the money other countries owe you is bigger than what you owe them. When Japanese companies build factories in the US, buy European bonds, or invest in Southeast Asia, all of that counts as Japan foreign assets. Japan held the number 1 spot for 33 years straight. Then, Germany knocked them off in 2024, and China pushed them to number 3 in 2025. The weak yen shrinks the dollar value of those assets, while foreign holdings of Japanese stocks rise. This chart tells the story of the yen-long decline. Back in 2012, $1 bought you about 76 yen. By 2025, the same dollar buys around 155 yen. That is a massive devaluation. Abenomics deliberately weakened the yen starting in 2013 to boost export competitiveness. It worked for exporters. But for regular Japanese people buying imported food, energy, and everyday goods, a weaker yen means everything got more expensive. That is the inflation side of the story that does not get told enough. This bar chart is where things get really uncomfortable for Japan. The labour share of GDP measures what percentage of everything an economy produces actually goes to workers as wages. The US and Germany, about 56%. The OECD average, around 50%. South Korea 47, Japan 46. That $10 difference per $100 of GDP, compounding over decades across an entire economy, is an enormous amount of money that never made it into workers' pockets. So, why does GDP keep growing while wages stagnate? In Japan, GDP gains are captured almost entirely by corporations and capital, not by workers. On top of that, Japan labour productivity ranks 28 out of 38 OECD countries in 2024. So, workers are not generating as much value per hour, and the value they do generate is not coming back to them as wages. Low productivity, low wage share. That is the structural trap that has been building for 30 years. Look at this monthly real wage chart from 2023 through early 2026. Every single bar from mid-2023 through the end of 2025 is below zero. Every single one. The worst months hit minus 1.8%. Then, right at the end, January 2026 finally pops into positive territory at plus 1.4%. February comes in at plus 1.9%. First positive reading in 13 months. Is this the turning point? Hold that thought. This three-line chart shows exactly why wages went up on paper, but down in reality. The gold line is nominal wages. They actually did rise. The blue line is CPI, consumer price inflation. It rose faster. And the red line is real wages, what you can actually buy with your paycheck. When inflation outpaces your raise, your real wage goes negative, even if your nominal paycheck is higher. That is exactly what happened in Japan from 2022 through 2025. Here is the core of the paradox. Most of Japan overseas assets do not belong to regular Japanese people. It is Toyota building plants in Texas. It is Sony buying IP overseas. It is SoftBank pouring billions into Silicon Valley. Some overseas income does flow back to Japan as dividends, but a huge chunk gets reinvested overseas, not channeled into domestic wages. Japan Vault is full. The average worker is just the security guard standing next to it. This is the smoking gun. The gold line shows Japanese corporate cash reserves, which have nearly doubled since 2012, from about 285 trillion yen to over 560 trillion. The red bars show average nominal wage growth over the same period. Wages basically flatlined until 2022. The money existed. The profits existed. The decision to not share them, that is what needs explaining. At this point, you are probably thinking, okay, so Japanese companies are just greedy, right? Half true, half not. The greed case is real. Record profits, OECD data confirming corporate profits outpaced wage contributions and cash reserves that literally exceed Japan's entire GDP. But the structural trap case is also real. Once you raise wages, you are stuck with them in a recession. 40% of workers are non-regular employees with zero bargaining power. No villains, but terrible results. Here is the verdict. No bad guys, but terrible results. That is the real story. The bubble collapse in the 90s, hardwired never overextend into corporate DNA. Non-regular employment exploded through the 2000s. Abenomics in the 2010s boosted profits, but kept wages minimal. And only now, with a genuine labour shortage and government pressure, are we seeing first real movement. But the underlying structure has not changed yet. Look at this trend line. In 1990, non-regular workers were about 19% of Japan workforce. By 2024, that number is around 37%, nearly doubled. Compare that to Germany at 13%, or the US at around 10%. When 4 out of 10 workers have no union representation and no real wage negotiation power, the entire labour market bargaining leverage collapses. Japan labour productivity tells a sobering story. Out of 38 OECD countries, Japan ranks 28th in GDP produced per hour worked. The US generates $78 of value per hour. Germany, 72. Japan, 60. South Korea, 52. Japan is actually below South Korea on this measure, a country that was a fraction of Japan's size economically just 30 years ago. Low productivity plus low wage share equals the double hit. Okay, here is the moment we have been building to. The double twist. January 2026. Real wages up 1.4%, first positive in 13 months. February, plus 1.9%. Base pay logged its biggest jump in 34 years. The 2026 Shunto landed at 5.26%, third year above 5. Sounds great, right? But here is twist 2. For every single month of 2025, real wages were negative. 5% nominal raises. 4 straight years of negative real wages. Inflation plus taxes plus social levies ate the difference. This chart shows Japan GDP per capita rank over time, and it is a slow motion collapse. In 1994, Japan was number 3 in the world. By 2010, already down to 17. By 2025, around 33. While Japan ranking fell, peers like South Korea and Singapore were racing up the charts. The money stayed at the national level, but the per capita story tells you what happened to actual people. This is one of the most striking charts in the whole story. In 1990, Japan was well ahead of both South Korea and Singapore in GDP per capita. By 2025, Singapore is at nearly $100,000 per person, more than twice Japan. And South Korea, which was a fraction of Japan level in 1990, has now overtaken Japan. The same country buying up New York skyscrapers in the 80s is now being lapped by its neighbours. This chart is the paradox in pure numbers. Gold bars are Shunto nominal raises, jumping to 5.3, 5.1, 5.26 in the last 3 years. Red bars are real wage change. Negative, negative, negative. For 3 straight years, workers got the biggest nominal raises in decades. And for 4 straight years, their real purchasing power fell. The gap is filled by inflation running 3 to 4%, rising social insurance premiums and new childcare levies. Let us bring it all together. Being the world number 3 creditor nation does not make your people rich. What matters is whose pocket the money ends up in. Japan labour share of GDP, around 46%, is one of the lowest in the developed world. No villains, but terrible outcomes. Bubble trauma, non-regular employment, and deflation created the trap together. The 2026 wage rebound is real, but without structural change, it may be just another blip. Next episode, 9 million empty houses, some selling for literally $1. Here is every key metric in one place. Net foreign assets, up, all-time high. Creditor nation rank, down, was number 1 for 33 years. Yen, down massively. Labour share below OECD average. 2025 real wages, 4 straight years of decline. Non-regular workers, 37%, nearly doubled since 90. Labour productivity rank, 28. GDP per capita, rank 33rd, 2026. Shunto, third year above 5%. February 2026. Real wages first rebound in 13 months, but with a question mark. That is a wrap on episode 2 of the Japan economy series, The Creditor Nation Paradox. 25 slides, 7 sections, 13 data visualizations. If this video gave you a new way to look at Japan economy, drop a comment below. Subscribe so you do not miss episode 3. 9 million empty houses, prices starting at $1, and why nobody wants them. See you in the next one.